You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Buck here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is Principal of Metropolitan Capital Advisors and Tanenbaum Equity Partners, Todd McNeil. Now, Todd is a co-founder and partner at Tanenbaum Equity Partners, which is a private equity firm formed by highly experienced principals focused solely on producing attractive risk-adjusted returns through domestic commercial real estate investments. Now, Todd's primary focus is sourcing and executing all investment directives for the firm's individual and institutional investment partners. Now, in addition to his involvement with Tanenbaum Equity Partners, Todd is also the principal of Metropolitan Capital Advisors, where he focuses on raising debt and equity capital for commercial real estate projects. He has arranged over $2 billion of capital on behalf of his clients for commercial real estate transactions comprising of all product types. Now, here's what you're going to learn on our show today with Todd. You're going to learn how he got to start initially as a broker, focusing on placing debt and equity prior to moving into a partnership role with the firm. You're going to learn what led to the formation of Tanenbaum Equity Partners in 2016 and the unique focus that they have on government leases. You're going to learn about the detailed process behind underwriting the quality of a government tenant in order to determine the overall stability and longevity of that tenant. You're going to learn what risk-adjusted returns Todd and his firm are seeking in these government tenants and the correlation behind the remaining lease term and the purchase cap rate. You're going to learn how he and his team converts the government's many inefficiencies into phenomenal investment opportunities. You learn how he and his team underwrite the future risk of self-driving cars, Uber, Amazon, and other disruptive technologies. You can learn about the benefits of experiential and discount retail trends and the projected growth of both of these niche sectors. You learn about the growing demand in the industrial sector that is directly correlated to the shift from street retail to e-commerce trends. And lastly, guys, I just want to give a heads up here that we actually had some sound issues on Todd's end of the interview during our time together. And so the quality isn't the greatest. And so this is really my proactive apology to you for the subpar listener experience. Okay, so with that, guys, I'm excited to get onto the show with Todd. But before we do, I just have a few quick housekeeping items I'd like to run through. Like I do every week, I like to share with you one of my personal bests and professional bests of the prior week. Now, personal best, my son Jackson, he's 6 years old, just turned 6 recently. He's been taking Taekwondo now, I guess, for about 4 or 5 months. He loves it. He's really into it. It's an after-school program that he's in, and he just moved up in belts. And so he just tested out and moved up from a white belt, and I forget the color now. I'm a bad parent, but he moved up from a beginner belt, which is a white belt, up into the next level of belt. And so, again, bad parent here because I don't know what color that is, but I thought it was a very cool experience watching him test, watching him really just own the sport. I mean, he's really into it, digging it, which it just, from a parent's perspective, really cool to see. As far as the one professional best, I had the opportunity the other day to spend an evening with one of the fastest growing parking lot operators in the country. Now, I actually met him during my recent attendance a few weeks back to a parking lot conference in Orlando, and I took advantage of his recent visit that he made to the Tampa area, where he operates some 90 plus parking lots here in the beach area of Tampa Bay. And as all of you guys are probably aware, I absolutely love niche investments, and so it doesn't really get much more niche than parking lots. And so it was great spending time with him. He's been doing the business for 9 years. Really sharp guy. He's from New England area, and he dominates 8 or 9 different markets, and just absolutely killing it in the parking lot sector. And so it was great spending time with him. Just again, a brilliant businessman, and also that space is very, very attractive in nature. It's very similar to what we do in the mobile home park space. After all, we are essentially renting dirt to folks that have mobile homes, right? So we kind of are in the parking lot space ourselves. Moving on here, guys, if you love what we're doing here at the Real Estate Investing for Cash Flow podcast, be sure to subscribe to the show. You'll be notified whenever we come out with a new episode. In addition to that, if you haven't done so already, please take the time to go leave a review and rating on iTunes. And like I do every week, I like to give a shout out to one of the listeners that took the time to do that. This review is from Devin Scott 7102. That's the screen name, Devin Scott 7102. And they'd say, this show was great. So much value you are bringing to the listeners. Thank you for teaching me so that I can go teach my family and friends as well. Keep it up, Kevin. Great. Well, I appreciate you taking the time, Devin, to leave that review. And guys, moving on here, I want to remind you really quickly of the free 30-minute call that I offer each and every week. You can go to my website, kevinbupp.com, and sign up for that. Very simply put, this is a way for me to connect with listeners, okay? You can go there, schedule a time to chat with me about anything your heart desires regarding real estate investing, okay? Again, go to kevinbupp.com to get that scheduled. And now, without further ado, let's get on to the part of the show that you've been waiting for, which is our interview with Todd McNeil. So here we go. Alrighty, guys, it's my honor to introduce my guest for today's show, co-founder and partner at Tanenbaum Equity Partners and Metropolitan Capital Advisors, Todd McNeil. Todd, how you doing today?
I'm doing well. How are you?
I'm doing fantastic. Thanks for joining me here today. And Todd, for those folks that aren't familiar with either one of those companies I just mentioned or you and yourself, maybe just take a few minutes and tell us a little bit more about who you are and ultimately how you got into this business.
Yeah, you bet. So 25 years ago, Metropolitan Capital Advisors was formed, and we specialize in debt and equity placements across the capital stack for commercial real estate investors, developers, property owners, et cetera, et cetera. And I was a finance major coming out of college and met my now partner in this business, and he took me under his wing as a mentor, and I learned the business from the back end up, meaning I started processing and closing mortgages that he was originating, and then I moved into an analyst role and analyzed all the deals he was doing for a couple of years, and then from there I became what we call a broker, and I was brokering my own deals for my own clients on the debt and equity side, and that was a little over 24 years ago that started. So I've seen a couple of cycles now, the dot-com bust to the Great Recession, and it's been a good run since our company's inception in 1992. We've done just over $14 billion of debt and equity placements, again, all in the commercial real estate space. And so I've kind of been here my entire life. I've never done anything other than this space until about 3 years ago, Tanenbaum Equity Partners was formed. And what Tanenbaum Equity Partners is a acquisitions platform where we specialize on buying properties that are solely leased to the government vis-a-vis the GSA vehicle. As everybody knows, when the government goes out and they need real estate for various agencies, they sign a lease under the government GSA space. So that's what we're after, is buying those buildings. And so that was born out of a finance assignment that I did for a very important client of mine, whose name happens to be Mr. Tannenbaum. And we started financing buildings for him on a one-off in that space. And then we figured out that once we aggregated a certain combination of various agencies, diversified both in agency type as well as geographically, that we can combine all these together and get an investment grade rating on a pool, because the government has an investment grade credit rating. And so once we were able to get a pool of these together and get an investment grade rating on the pool, it opened up all kinds of finance avenues on how we can leverage these assets to make them very profitable for us. And so the combination of Mr. Tannenbaum's experience in that space and his balance sheet, and my combination of finance acumen with my partner, Sonny, we were able to come together with his daughter, Becky Malice, who runs all the asset management and property level management for us, and create the company Tanenbaum Equity Partners, which is right now we have about $178 million of total properties under our watch, about 49 assets all over the United States. So as you can see, my time at Metropolitan Capital was accretive to what we were doing on the Tanenbaum Equity Partners side, which is why I'm able to do both at the same time. So that's a little bit of background about who I am and my two companies.
Very, very interesting. So with regards to Tanenbaum Equity Partners and your core focus being those government assets or government leases, you mentioned all across the U.S., right? So there's no specific market or MSA that you guys are targeting. So Correct. This is strictly based on the stability of a government lease. It doesn't matter the market that it's in. It's really the stability of who you're lessee is, which is the government, correct?
That's accurate. And we go deep into why that agency needs to be there, what their mission is, does the space work for them, what in the future could possibly cause them to leave. And we underwrite all those things as we're looking at an acquisition. And what we're trying to determine is how sticky is that tenant and how long are they going to be there? Because in most cases, not all, we're looking in tertiary markets where if that tenant were to leave, it would be very difficult for us to backfill that space with another tenant. Some of the buildings we have are in Sault Ste. Marie, Minnesota, all the way down to Rio Rico, Arizona on the border, which is a Customs and Border Protection building. And so obviously, as you can see, there's reasons for those tenants to be there, and we underwrite their stability and their longevity in that space.
What's a typical lease length that you guys are seeking? Like, what's the minimum that you're going after?
Okay, so it could be across the board. I would say, as opposed to lease length, what I'm really looking for is why they need to be there and how sticky they are.
Okay.
And also cap rate. So I'm trying to seek something in a certain cap rate range, which pretty much dictates that I'm looking for leases that I say would have 4 years or less remaining on the term. Anything above 4 to 5 years, the cap rate starts to get a little bit rich for my taste. And we would not, by definition, pursue those, although we do have some in our portfolio that have long lease terms, but it's not our core focus.
Okay. Got it. So now that makes sense. So you guys are looking for the ones that most others are not looking for because they find that there's risk, or they think there's risk, inherent risk in the length of the term that's left of that lease. However, your evaluation model allows you to determine what risk really lies there based on, how needed is that government agency in that respective space.
That's right.
What did that analysis? I mean, did you guys put that together yourself in house? I'm assuming there's got to be hundreds of different data points there that make up that analysis.
Some of it we put together in house. We have a really good management team out of Chicago that helps us source some of these, and they also develop as well. So they don't really compete with us, but they're in that space, and so they understand why a tenant would go develop there for the GSA. And through our process of, some of it's been by trial and error, Kevin. We've lived and we've learned, and as everybody has in this business. And so with each agency, we know what they're looking for. We know, for example, I can go into a Social Security Administration office and I can know what kind of retrofits they're going to need by the look of the building on the next lease term. And so I can therefore start forecasting how much capital I might have to put into that building in order to induce the Social Security Administration to stay for a longer term. And a lot of that we can do by boots on the ground, going and looking at the real estate. And you'd be surprised with anything what kind of answers you get if you just ask the question to the tenant. Are you happy there? What works for you? What doesn't work for you? What would you like changed? And when you're walking through these buildings, it's amazing. We always kind of use the term when they unpack their bags. We get to see what's in their suitcase. And so that helps us tremendously. So we've had a really good track record. And I think, as everybody on this call probably would understand, as the government by itself is a very inefficient vehicle. And for them to make a change and for them to go do something different or build a new building, that's where the term "as an act of Congress" came from, because they have to go get appropriations. They can't just say, I'm building a new building. They have to go through Congress and get it approved. And so if you are looking in the right places and you have the right dynamics for them to grow, it's highly likely that tenant's going to be there for quite a long period of time.
Very interesting. And who is the typical seller that you're buying from? Are these other private endeavors, or do some of them happen to be owned by the government and they're looking to essentially do a leaseback?
None of them have been owned by the government. Most of the time they're owned by anywhere from mom and pops in that local market. Say, for example, Sault Ste. Marie, that guy owned the land, GSA wanted to build there, he built them a building and it works, and now they're coming to the end of their lease term and the owner doesn't know what to do and he doesn't want to take the risk to backfill them, so he's looking to sell. And in some cases, we have institutions that are in our space that, for whatever reason, this particular property might not work for their portfolio, or they might need to offload it. So we have bought from some institutions as well. Okay,
sounds good. And as far as Metropolitan Capital Advisors, let's talk about that side of your business a little bit. Again, you wear multiple hats there. Other than the government these governmental assets that you're working with for Mr. Tannenbaum, what other assets do you focus in there as far as placing debt and equity? Is it all across the board, all across the spectrum?
It's all across the spectrum, from land to multi to industrial to retail. We do a fair amount of each of those categories. Every once in a while, Kevin, we do get into a situation that has no real estate and it's all operations intensive. For example, my firm financed last year a recap of a hospice business that did not have any real estate, and the client came to us because he thought we had the acumen to find the capital needed for what he was trying to do. He was correct, although before we took on the assignment, we certainly had the conversation with him that, hey, we're not experts in the space you're looking for us to do. However, we know the capital of where it's at, so if you can help us with the technicalities of your business, we can help you find that capital. So that's a very small sliver of my business. Most of it is right down the middle of the fairway, retail, industrial, multi, office, land, mini storage, and I'm a hotel. We do a ton of hospitality. So it's pretty much those food groups there, Kevin.
Okay, got it. Speaking to different technologies that are kind of interrupting or disrupting the space, or that might disrupt it here in the future, being that you guys spent some time in the retail sector, what are your thoughts, and how do you guys kind of factor in risk of the future of autonomous vehicles and the future of the Ubers of the world and things of that nature? Is that something that you guys kind of evaluate today, or is it just not that big of a risk at this point in time?
No, we talk about it all the time. It's not in the next 10 years, but probably beyond 10 years, we're going to start to see it take effect. So look, on retail deals, we're very cautious about what are the size of the boxes, especially when you're looking at the Best Buys of the world, some of the pet supply stores like PetSmart, Petco. All those guys are, and even Ross to that extent, which is what we call a treasure finder in our business. Ross is reducing their footprint. So when you're going to acquire a retail center, you're going to want to look and see how big those boxes are, because if you have a Best Buy in an older form of their box, you automatically know that when they come up for renewal, they're either going to be leaving the space or reducing their footprint significantly. So you have to factor that in. The other thing that is becoming very heavy in our business on the retail side is you want to have what's called experiential retail. And what that is the movie theaters. It's the dining places. It's a reason for people to come to your center, other than the typical reason was, well, I'm going to Best Buy to buy a stereo, because a lot of times those customers are going in there and they're looking at the stereos, but they're going online and they're buying them after they leave. And so if you have a heavy restaurant or if you have a movie theater, people are coming there for other reasons. And they might look over and see Best Buy's like, oh, I'm going to pop in there, and they might buy something, maybe not. So the new trend in retail is with experiential retail and what I just referred to a second ago called the treasure finders, which is where women and men want to go to find the best deal, which is the Ross Dress for Less, things like that, where they walk out and they think they got something for a good price. And that has not died yet. Kohl's is still very active in that space. So they're still expanding and still doing deals. Dollar Tree, another one. Tuesday Morning is another one. Those guys seem to be very prolific, and we're not so worried about them on the retail side. But you want to be able to buy a center and look at centers that have a nice mix of that experiential feeling as well as the traditional retailers.
Got it. How about on the flip side of that, speaking to, walking into a Best Buy and then going on Amazon and buying that product? I mean, obviously e-commerce has a major effect on retail, but I don't want to speak about the retail side of it. I want to speak about the demand for the industrial component, right? The actual offsite warehouses where, these different supplies are being held before they get shipped out. Have you seen a major increase on the industrial side of things as far as new builds or interest in that asset class?
100%. We here refer to industrial as the new retail, just for exactly why you just said. And we see a heavy ramp up of industrial development, especially in my backyard in Dallas-Fort Worth. The industrial development, I think, is some of the most prolific in the entire nation. And we have a vacancy rate here of close to 3%. Wow. And there's new building going on all over the place. And the reason why is exactly why you said, because Amazon is locating places and all these retailers don't want to have all the retail storefront because that's the most expensive rent. They could have a smaller footprint and have bigger industrial and pay the cheaper rent and still get their products out to their customers. So I would tell you in a facetious way that industrial is the new retail.
Very interesting. And I guess in Texas, you don't necessarily have to worry about it, but I'm assuming that you guys have probably dabbled somewhat in, the marijuana trade now, right? The demand for whether it be grow houses or distributors or medical facilities in industrial type settings. Have you guys played in that space, or is there really not any debt available per se for that based on the federal regulations that still are imposed on it?
There is debt available. It has to come from a private money source.
Okay.
That's non-FDIC regulated.
Got it.
But I will tell you that there is some issue with title policies on these marijuana facilities. And so you have to find a title agent that's willing to give the protections that is needed for the first lien lender. There are a few out there. There's not a lot. So you really need to do your research if you're financing a marijuana facility. But to your point, Kevin, that industry growth has spurred a massive desire for Class C and Class D industrial in markets like Colorado, Oregon, Washington. Because why? Because usually those Class C and Class D industrial developments are either no longer leveraged or they're owned for cash. And a tenant that's going into those spaces has to, let me say this a different way. A lender cannot make a loan on a building that has that as a tenant because it's federally illegal. And so most of those centers that are older in nature and are owned by cash, and so you're able to sign those tenants. And so you're seeing a resurgence of the Class C markets in places like Denver, where all these facilities are being put in these older buildings, and they're paying rents that are off the charts because they can get it. The landlords can get it. And so if you're going to get leverage on those, you can go to a private lender. You're probably going to be looking at 11 to 12% interest only, and you're probably looking at 50% of value, and not the value of the income stream that's in place from the marijuana tenant, but rather the value of what it was going to be if they had to lease that to a traditional industrial tenant.
Yeah, very, very interesting. Something to think about. How about multifamily? Seems multifamily has been the flavor of the day for the last couple of years, really the last decade. You're rolling out of the Great Recession. What are you seeing as far as overall volume? I'm assuming that you guys have been involved in a lot of different multifamily transactions here over the last couple of years. And is it continually to heat up, or is it cooling off a little bit? What's the general thing you're noticing?
I would say it's been pretty steady, Eddie. It's been very frothy the last 10 years, as you just mentioned. There's a lot of development going on, but there's this shift where people just want to rent these days. And I keep thinking that's going to turn. And as you always grew up as a kid and home ownership was where you strive to be. I think that could come back. However, every year I seem to get proven wrong on that, and rental properties still seem prolific, and they're still building. I am not overall worried about that market from a recession perspective because lenders in that space have been very disciplined. There's real equity going in those developments. Sometimes on the higher end multis, on the Class AA's, there's 40 to 50% equity going in. So I don't think that if the market was to turn, that we would be seeing a wave of foreclosures on the market and lenders taking back those properties. Rather, I would tend to tell you that I think the equity is going to get either wiped out, or they're going to have not the returns they otherwise perform because rents will drop. But it's not going to get to the level to where the first lien debt is going to take a hit. Now, that's not in every case, obviously, but I think that's in most cases. One of the things I can tell you with recession that hasn't really changed is the discipline in the underwriting from the capital. Pre-recession in 08, 07, 06, we were underwriting transactions on pro forma. And lenders would take those at 80% of value all the way down to a 120 debt coverage ratio pro forma. And as we saw in 2009, 10, 11, that didn't really work.
Yeah. But are there any common themes that you see playing out today that ultimately occurred during the last downturn?
That's a great question. I think the common themes are that, people are still going about their business the same way, but what's changed or I'm not really answering your question because I think there's a lot of changes post-recession, but there's real equity going into deals. There's lock boxes in place for the non-recourse lenders so people aren't stealing the money before they give their properties back to the lenders on a non-recourse basis. And they're not underwriting pro forma. So I think that all that's gone away. But the commonality of what they did before between what they did now is just in the standard underwriting procedures of how they arrive at their NOI. That's all. That hasn't changed.
Got it. A question I wanted to ask when we were talking about industrial and retail, and I don't know the answer to this, and so it's an authentic question as far as non-recourse debt. Obviously, non-recourse debt I know is available for the multifamily side of things. Is there readily available non-recourse debt on the other asset types? Be it self-storage, industrial, retail, office, what have you?
I would tell you that there's non-recourse debt available for just about anything these days. It's a function of price. And so, yes, you indicated that the multifamily space has a very prolific government-subsidized non-recourse program vis-a-vis the agencies of Fannie and Freddie and HUD, FHA. There's similar vehicles for office, retail, self-storage in the Wall Street CMBS conduit world. And so Wall Street will give you 10-year, long-term, fixed-rate, non-recourse financing for any of those product types that I just mentioned. What they're not going to do is non-income producing assets. However, there are other subset of lenders that will do non-income producing assets on a non-recourse basis. It's just going to cost you significant rate. So, for example, you could get a non-recourse construction loan for a retail center, probably starting at 6.5%, 7% interest. If you sign that same deal with recourse, you're probably borrowing at 4% to 4.5% interest. So
got it. Yeah, no, we're very familiar with the Wall Street space. We're in the manufactured housing space, so we've done a number of CMBS loans here over the last year or two. And but however, I was not sure if there are certain asset types that CMBS does not dabble in. So, but it sounds like you answered the question that they'll pretty much go anywhere, but the pricing might be a good bit higher than full recourse.
That's right.
I'd love to move into what I call it the lightning round, Todd, if we could. And I got 6 very targeted questions, very short questions, looking for a short answer. And so let's get rolling with it. How about your biggest fear? What is it?
My biggest fear is all my brokers walking out the door tomorrow and and going to do something else. I got a great team over here, great people. So I want to keep my family together.
That's awesome. One biggest regret in life, whether it be personal or business?
Business. One of my regrets was not getting into principal ownership earlier. Personal was not having, I waited too late to have kids. I was married for 10 years before I had kids. So knowing what they are now, I wish I'd had them 10 years prior.
Good deal. How about most influential business book ever read?
The Art of War.
Yeah, that's a wonderful one.
Yeah.
One thing you can't live without?
One thing I can't live without is my family.
Got it. And the most rewarding part of being an entrepreneur?
Is that you get to do something different every single day, and it's not the same and it's not mundane. I don't come to the same rock pile and chip the same set of rocks. I get to do something different every single day because I'm working across all property types with all different borrowers. Everybody's circumstance is different, and it keeps me energized and motivated to come back every day. Otherwise, I'd be bored.
Yeah, I love it. And my favorite question, we save this one for last. What would your plan B be if one day you decided that you no longer wanted to do what you're doing, or if your team walked out on you? What would you do at that point in time?
So plan B, I would be in the computer MIS space. And here's why. Because there are many times throughout my business that if my computer or my network goes down, all of a sudden my entire team is down, and I'm at the mercy of somebody to come in and fix this. And I don't know what the heck they're doing or how they're going to fix it. And they can tell me anything they wanted to, and I'd say, just get it fixed so we can get back online. And I think as we move into this digital age, that's going to become even more pertinent, and we can't live without the IT guys. You just can't do it.
Oh, very, very true. Todd, what's the best place to find out more about you and your company and different services that you guys provide? I know you got 2 different companies we've been talking about here today. What are the 2 websites to send people to?
So one is www.metcapital.com, and the other one is TannenbaumEquityPartners.com. So you can go to either of those 2 websites and look us up. And if you guys or your audience members need any help with debt and equity placement, feel free to give me a call and we can walk through any scenario you have and I can tell you how we can add value.
Got it. Real quick, one last question I meant to ask a little earlier on. Minimum loan size, where are you at? 5 million range? You go down to
we try to stay 2 million and up.
Okay.
So anything below 2 million, we'll certainly listen to it, but the amount of lenders that are doing stuff under the 2 million is very sparse.
Yeah.
So it's hard to add value. Yeah.
Got it. Well, Todd, thank you so much for coming to the show today. It's been a blast having you. And thank you, each and every one of you, for tuning in for this week's show. And until we meet again next week, this is your host, Kevin Bupp, signing off.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.